When management is determining which of two different decision alternatives to take, the question they're really asking themselves is, what difference are we going to see in our profitability if we take option A versus option B? So when you are making a decision, be it short-term or long-term, what you can do to figure that out is do a differential analysis. Go through, find all of the relevant information to your two different alternatives, throw them into some kind of accounting statement, and determine from your calculations what effect those two different alternatives are going to have on your overall income. Some types of decisions, I should say, where you're going to have different options that you would want to do a differential analysis for are, starting with pricing, what should your regular price be? That is your standard going price that you sell on the market for, your manufacturer's suggested retail price, or your MSRP, if you will. Should you do special pricing? Should you deviate from your regular normal price for a particular reason? Does someone want a special order? Does someone want a discount on it? Should you do this or not? Look at your two different alternatives, yes or no, and figure out what difference they're going to make to your income. Your mix and your different products and segments that you make. Should you continue to do them, or should you discontinue them? If you're making 5, 6, 7, 8 different products, maybe one of them is not really carrying its weight. But getting rid of it might not help your overall profitability if there are costs that you are stuck with if you discontinue that product. The same thing is very true for segments if you have a multi-segmented business. For your mix, you take Apple for example. Some of their products are more profitable than others. Should they emphasize selling more tablets, iPads, versus their laptops, or should they look and try to emphasize their MacBook instead? How do they change their mix? What, of their different products do they want to sell more of? Outsourcing. Should we have someone else elsewhere make the products for us, or should we continue to make them ourselves? And processing further. Should we sell the product as is, or are there any fancy bells and whistles that we can add to this product that's going to make it more enticing to our customers, and therefore we can charge a higher amount for? All of these things will have different effects on your income, and to determine what that effect is going to be, do a differential analysis. Again, what you're going to need to compile this is your relevant revenues that occur within one of your decision alternatives that don't within the other. Relevant costs, same thing, costs that incur within one decision alternative that won't be incurred by the other, and ultimately what your profits are going to be between your two different alternatives. There are different ways to do this, but the most common way is to do the contribution margin approach. Separate which one of those relevant costs are variable from which of those relevant costs are fixed. Let's start with regular pricing. This is what you are telling retailers. This is what you are selling to retailers for if you're a manufacturer. Or if you are a service business, this is what you're selling your services to the public for, your normal standard price. What questions would you have to ask yourself when you are setting that regular price? Well, firstly, what amount of money do we want to make? Every company has owners. If you're a small business and entrepreneurship, sole proprietorship, I should say, you're going to have a number that you need to make your business worthwhile, taking all of your time and effort. If you are a publicly traded company, your owners are all the different people that own stock in your company. They're going to want and expect you to make a certain amount of money during the period. So what is that target profit that you need to get to, your bottom line, because your price point is going to help determine that. Borrowing on economics here, what amount will customers pay? A demand curve says that the more and more you charge for something, the less amount you're going to be able to sell. You're going to price people out of your particular product. Well, whereas the sweet spot on that demand curve that maximizes your overall profitability, what are your expectations for your customers' willingness to pay a certain price? And lastly, but very importantly, are you a price taker or a price setter for your product or your service? What is the difference between a price taker or a price setter? Well, let's go a little deeper into it. A price taker is a business, be it a manufacturer or a service company, that operates in an industry, in a sector that is highly competitive, where services or products aren't really that different from one supplier to the next, and therefore they have very little control over their ability to set price. They are forced by the going price of that market as a whole to sell at a price that is similar to their competitors. A price setter is the opposite of that. It's someone who has a product or service that is in one way or the other differentiated from the products or services of its competitors. And with that, you're unique. And when you're unique, you're not tied to the fact that, hey, if we jack up our price, people are just going to go and buy from our cheaper competitors. You're unique. You don't have very many competitors in your industry. You can charge whatever you think is going to maximize your profit. That makes you a price setter. So the two big things that are taken into consideration when determining if you are a price taker or you're a price setter is the uniqueness of your product and the amount of competition that is in the market for selling a product that is similar to yours. If your product lacks uniqueness, if it's milk or bread that everybody manufactures in a similar way, well, then you're going to end up being a price taker. And there's a lot of companies that manufacture those products. There's intense competition that even reinforces the fact that you're going to be a price taker. So if you're a price taker, you're going to emphasize what they call target pricing, which I'll get to in a minute. If you are a price setter, your product is incredibly unique. In fact, it might be completely unique. You have bread as an industry, but if you're making very expensive, super healthy bread, well, you've added uniqueness to your product. Not everybody has that type of product on the shelves. You can kind of dictate what you're going to sell it for. And since everybody doesn't have that product on the shelf, not every baker is making that particular product, you have less competition. If that's the case, if you're a price setter, well, then you're going to emphasize a different pricing strategy called cost plus pricing. So let's break them down. And we will start right now with price takers. Price takers are going to use a target full product cost to determine how they're going to get to the level of profit they want to have. They are operating in an industry, where the price they can sell their goods or services for is kind of dictated by the competition. That revenue at market price, they don't have a lot of say over. If you want to think of a way, it's kind of fixed, the amount of revenue that they can make off of any one given product, because it has to be competitive with the price their competitors sell for. They have a desired profit. Again, either the owner or owners has come through and said, this is the amount of profit we expect to make during the period. Well, if you have to have that level of profit and the amount of revenues that you can make are kind of set by the competition of the industry that you're in, your only way to affect your profit, because you can't change revenues, is to change your cost. So in this case, since you are a price taker, you're more concerned with what the full cost of your product is to get to that profit level, because you can't really change your amount of revenues. We have Smart Touch Learning over here. They have a budgeted income statement set up with the contribution margin approach, where they've separated their variable costs and their fixed costs. They are going to expectedly generate $1.2 million in revenues. They think that to get to those $1.2 million in revenues, they're going to incur $738,000 of total variable costs, leaving them with a contribution margin of $462,000, with which to cover their fixed costs. And after they pay those budgeted fixed costs of $226,000, they expect to have operating income of $236,000. Well, let's suppose over here that Smart Touch Learning has owners or investors. Somebody is tied into this company and they expect a certain return. And their return is going to be return on assets. For the technology-based industry that Smart Touch operates in against their competitors, the average is somewhere around 10%. So essentially profit for each period is going to be equal to 10% of the assets that you work with. Well, if Smart Touch has $2.5 million in assets and their owners expect a profit to be equal to 10% of the assets they have to work with, they're going to expect profit to be $250,000. And as we can see from our previous income statement, that's problematic. We're not, according to our budget, as it's currently set up, going to have operating income equal to the profit that our owners want us to have. We are $14,000 too light in this case. Well, we are a price taker, which means our revenues, we don't have great control over changing for the amount of units that we're going to sell. If we expect to sell 2,400 tablets, the going price across our whole industry is $500 per tablet. That means that's how we're going to generate the $1.2 million worth of revenue that we propose on this budgeted income statement. We don't have a great way to change that. And our owners are expecting us to come up with $250,000 of profit. Well, if we have to have that profit level and we can't change the amount of revenue that we generate, our only option, really, one of our options, but our main option, is to somehow figure out how to make 2,400 tablets for a cost of $950,000. As it stands right now, going back to our income statement one more time, SmartTouch is expecting to have $738,000 of total variable costs, $226,000 of total fixed costs. You add those two together, and you come up with $964,000 worth of total costs that they are going to expectedly incur during the period. Well, it's not going to work for us. We got to get it down to $950,000, reducing our costs by $14,000 will increase our profits by $14,000, which will take us from that $236,000 we budgeted for up to the $250,000 that our owners are expecting. Well, how do we do that? Well, we got options here. The first option is we don't think it's possible. We don't think that we can lower our costs by that amount of money to increase our profitability. And we go to our owners at a shareholders meeting and we say, listen, $236,000 of operating income versus the $2.5 million of average assets that we have to work with is a 9.44% return on our assets. That's pretty close to 10. Yeah, will you be happy with this? Good luck trying to get shareholders to say yes to that, but it is an option to try to convince the people that are dictating what they expect your profitability to be to accept a lower return for one reason or another. But if they're unwilling to accept that, well, then we got to get rid of $14,000 in cost because we are a price taker. So we can reduce our fixed costs by $14,000. We can reduce our variable costs by $14,000. Maybe we can find some mixture of those two to get us down $14,000. We got to reduce costs by $14,000. Another option that we have is to try to attempt to increase our sales volume. We are stuck at the price that we sell for, but since the amount of fixed costs that we have related to production is not going to change if we have more units sold, we will actually end up being more profitable as a whole in the long run if we can sell more units. So we'll keep the same consistent margin that we have per unit, but since we sold more units, our overall contribution margin will increase to the level of profitability that our owners expect. We have a social media campaign go on, some kind of promotion that's going to increase our sales volume. We can go through and we can try to change our mix. As it looks right now to me, going back through our slides here, we're expecting, there we go, $1.2 million in net sales revenue. And the only product it appears that we are selling is tablets to get to that $1.2 million. Well, what if we use some of our production capacity, reduce the amount of tablets that we are going to make, but we add a second product into the mix? Smartphones, watches, whatever you wish. We add more products that are hopefully more profitable. If we scale some production away from the less profitable tablets into our more profitable new products, well, then our overall profitability should go up. So maybe we can augment our mix by coming up with new products. We can look and say, being a price taker sucks. Our tablets are just like everybody else's tablets. How do we fix this? And we try to do something to our tablet computers which differentiates them from our competitors. And Apple, when they were in competition against Microsoft way back in the day when computers became a thing, absolutely did this. They decided, instead of putting in stuff with DOS, which I know I'm dating myself right here, but when I was a kid, you literally, when you fired up your computer, had to type in a command and hit enter to get a program to fire up instead of just clicking on an icon, which is the graphic interface that Apple came up with. And when they did so, they differentiated the Mac from a PC with that interface. And it led to them being massively profitable until Microsoft stole their idea and they had a decades-long lawsuit over whether that was proprietary, if they could do that or not. End up losing that. I'm getting off track right here, but what I'm saying is you can find something about their tablet, SmartTouch can, that makes it more desirable. You have more USB ports. You know, have a longer lasting battery than any other tablet on the market. Whatever it is, find something that makes yours better than theirs, and therefore you can sell yours for more. You don't have to pick one of these alternatives from the other. There's times, as long as you have the ability to do so, you can find some combination. Maybe we'll slightly differentiate our product. Maybe we'll get some cheaper parts for it to reduce our variable costs, and maybe we will market a little more to help increase some of our sales volume. You can mix and match from the different strategies. But in the long run, if our investors are unwilling to accept that lower rate of return on our assets, we need to find some way in combination to increase our profitability by that 14,000. Well, that was a little bit of a nightmare, and being a price taker is not a fun thing. Being a price setter, way more enjoyable, because you have control over your price. Which means if the profit that you have is not the level that you want, and you know how much production is going to cost, well, then you can just increase your price. And increasing your price, since you have control over it, more revenues versus the same amount of cost is going to lead to more income in the long run. So price setters use cost plus pricing. The cost that you expect manufacturing to be, plus the amount of profit you want to make, leads you to the amount that you should sell your units for. And here is SmartTouch's setup in all of its glory. They have current variable costs. All these same numbers, I'll back up again for 1 second, are coming from the same income statement over here that we started with. They have current variable costs of $738,000 for the 2,400 tablets they expect to produce. That's $307.50 of variable cost per tablet. They expect in their budgets for their fixed cost to be $226,000, which, as we've seen on the budget, that means they're expecting to pay $964,000 for operation costs during the period. And their owners want that 10% return on the $2.5 million of investments. They want $250,000, which means if it's going to cost us $964,000 to produce these 2,400 tablets in total, and we want to have a profit of $250,000 left over, well, then we have to generate $214,000 worth of revenue across the sale of our 2,400 units. Well, we're price setters. We can sell for whatever amount we want to. We are in a market that's not quite as competitive. We found a way to differentiate our product. We can choose our price point. And to get to that price point, just take the amount of revenue you need divided by the number of units you expect to sell, and it tells you what you think your profit, or what you think your sales price should be per unit to get to that level of profit. In this case, for SmartTouch, to fix our issue right here with our investors not being happy with the level of profit we're going to have, we just jack up the price $6, and now we sell them for $506 per unit. Being a price setter is a way better spot in the industry than being a price taker. Unfortunately, for most companies, when they come up with a unique product, as soon as it starts moving units, every other company is going to try to find some way to mimic it. So you're not going to be able to be a price setter for forever. Make your money while you can. So what is our decision right here? Our decision between our two different alternatives is pretty simple. How are we going to fix our profitability issues? How are we going to increase our profitability? The first question, are you a price taker or are you a price setter? And if you are a price taker, your only real option is to find some way to reduce costs, because you can't really change the price that you sell for. If you're a price setter, well then, you could look to reduce costs, but you have the option of increasing your sales price, just like SmartTouch Learning did, to get to that target level of profit that you so desire.